Marcus is 28. He has a job. Not a dream job, but steady enough to pay rent, cover his bills, and tuck a little away most months. He has an apartment he actually likes, a car that still runs, a credit card balance he's been chipping away at, an investment account with a modest sum in it. He is not rich. He is not struggling. He is getting by, like most of us. He has heard the word recession for over a year now. In the news, in his group chat, from his parents who remember 2008 the way people remember the weather on a terrible day. But he has not really thought about what it actually means. Not for him. Not specifically. Why would he? He is fine. Then, one Tuesday morning, he opens his email. 3 months later, his life looks completely different. And if you ask him what went wrong, he will tell you he did not see any of it coming. That is the part of a recession nobody explains. What it actually does. Not to the economy, not to the stock market, to you. This video is the plain version. No doom, no false comfort. Just what a recession actually does to the life of a regular person. The person who, historically, feels it first and recovers last. A recession happens when the economy shrinks for 2 quarters in a row. GDP, which is the total value of everything the economy produces, goes negative for 6 months. The National Bureau of Economic Research looks at a few other things too: jobs, income, spending. But the 2-quarter rule is the one you have heard. That definition is useful for economists. For you, it translates into something more uncomfortable. Companies stop growing. They start cutting. Jobs disappear. People stop spending because they are scared or broke, or both, which causes more companies to cut, which causes more job losses. It is a loop, and it feeds on itself until something breaks the cycle. Here's the part nobody says clearly enough. By the time a recession is officially declared, regular people have been living in one for months. The official announcement lags the reality by a long time. The economy has to be shrinking for 6 months before anyone on TV says the word out loud. Meanwhile, the people who got laid off in month 2 did not need a press release to know what was happening. Let's start with the most immediate effect, because this is what people actually fear when they hear the word recession. Your job becomes less secure. Full stop. In 2025, U.S. employers let go of more than 1.2 million workers through layoffs. That is 58% higher than the year before. And that number did not arrive all at once. It came as a slow drip of emails, department restructurings, and meetings with HR that started with, as you know, the company has been going through some changes. In an actual recession, that drip turns into a flood, and it is not random. The people who get cut first tend to be the newest hires, the highest cost employees relative to their output, and the people in roles that are easy to consolidate or outsource. Younger workers, recent hires, entire middle layers of management that companies suddenly discover they never really needed. Even if you keep your job, the threat itself changes how you operate. You stop asking for raises. You stay in a job you were thinking about leaving. You say yes to extra work you would have pushed back on last year. You become, in corporate terms, flexible. A recession does not just affect people who lose their jobs. It affects everyone who is afraid they might. Here is where it gets worse. Credit gets harder and more expensive. When the economy contracts, banks tighten. Lenders raise credit score thresholds, increase down payment requirements, and become pickier about personal loans. Credit card companies quietly cut limits and nudge rates upward. If you were already carrying a balance at 22% APR, a downturn won't help. It may make borrowing costlier just when you're most likely to need it. The people who need credit in a downturn are often the ones who find it hardest to get. Prices do not automatically drop. It's a common surprise. Shrinking economic activity does not mean everyday costs fall. Home prices and used cars can soften, but essentials, groceries, utilities, rent, healthcare, often remain stubbornly high or keep rising. In severe cases, you get stagflation, prices climbing while output and jobs fall. Rent is especially cruel. When buying slows, more people stay or return to renting, and more renters chasing the same units keeps rent steady or pushes them up. In 2008, home values crashed while rents rose, exactly how the system can punish those without housing equity. Your investments take a hit. Markets usually fall during recessions, sometimes dramatically. A 401k or investment account can drop by a third or more in weeks. Watching those numbers fall is unsettling, but the loss only becomes permanent if you sell. Historically, markets have recovered after every U.S. recession. The lasting damage comes from panicked selling at the bottom. If your money is meant for the long term, resist the urge to lock in losses. These effects compound. Credit tightens when you need it, everyday prices often won't give you relief, and market downturns test your patience. The combination is what makes recessions feel personal, not just statistics, but the squeeze on your ability to pay bills, protect savings, and keep options open. Here is the part most economic coverage glosses over. A recession does not land equally. The people who feel it first and hardest are the ones who are already closest to the edge. No savings buffer. Working in industries that cut quickly. Retail, hospitality, construction, parts of tech. Contract workers with no unemployment backstop. People with variable income who are already managing month to month. The people who feel it last, or sometimes barely at all, are the ones with savings, assets, and jobs in recession-resistant fields like healthcare or government. People senior enough to be expensive to replace, but essential enough that cutting them would cause real damage. The gap between those two groups does not just persist during a recession, it widens. People with assets often come out ahead. Homeowners who bought before the downturn see long-term gains when values recover. Investors who held through the crash watch their portfolios rebound to new highs. Meanwhile, the people who were renting, spending every paycheck, and had nothing invested have nothing to recover. They just wait for it to be over and then start rebuilding from zero. A Marist poll from late 2025 found that 52% of Americans already believe the country is in a recession, regardless of the official definition. That number is important. The official definition and the lived experience are not the same thing. For a large part of this country, the conditions of a recession, tight money, job anxiety, rising prices, shrinking options, have been the daily reality for a while already. This is the practical part. No lecture, just the moves that actually matter. Know your runway. The most useful thing you can do right now is know exactly how long you could pay your essential bills if your income disappeared tomorrow. Rent or mortgage, utilities, groceries, insurance, minimum debt payments. Add those up. Then look at how much cash you have that you could access without a penalty. The result is your runway. 1 month, 3 months, 6 months. The financial advice target is 3 to 6 months. Most Americans have less than 1. Knowing your actual number is the first step to doing something about it, even if the number is uncomfortable. Kill high-interest debt while you still have income. In a recession, credit gets more expensive. The time to reduce what you owe on high-interest cards is before things get tight, not during. A $5,000 credit card balance at 22% gets harder to manage, not easier, during a downturn. You do not need to be debt-free. That is not realistic for most people short-term. But dropping the balance on your most expensive debt right now is one of the highest return financial moves available to someone with a steady paycheck. Do not panic sell your investments. This is the mistake that defines recessions. People see their 401k drop 30% and they sell to stop the bleeding. Then the market recovers and they are not in it. They locked in the loss and missed the rebound. If the money in your investment account is long-term money, let it be long-term money. The market has recovered from every single recession in American history. Every one. You just have to stay in your seat. Make your income harder to cut. This is less obvious, but it matters more than it sounds. Being useful and visible in your organization makes you harder to eliminate, which means understanding which of your work actually generates results the company cares about and doing more of it. It also means having at least one income stream outside of your main job if you possibly can. Not because you need to hustle 80 hours a week, but because a recession is exactly when you want options. Freelance work, consulting, something that pays even a few $100s a month outside of your regular paycheck. That flexibility is a very different feeling than a single income stream that can be taken away in a 5-minute meeting. None of this is a magic fix. A recession is structural. It affects everyone. But the people who come out of it in roughly the same position they went in are almost always the ones who saw it coming and did something while they still had time. A recession is not the end of the world. It has happened before. It will happen again. It always ends. But it does not end the same way for everyone. The people who go in with savings, reduced debt, and some flexibility mostly absorb the hit and recover. The people who go in already stretched, already stressed, already one bad month from trouble, feel it in a way that takes years to undo. The difference between those two outcomes is not luck. It is information and time, both of which you still have right now. Subscribe if this channel is helping you see what is actually happening, and share this with someone who keeps hearing the word recession and wants to know what it actually means for them.